and why multifamily syndicators, operators, syndicators, sponsors, those terms are used interchangeably with one another, and passive investors. So if you're a passive investor and you're listening to this, don't tune out. Pay attention, because it's important for you as a passive investor to learn how you can deploy your capital and utilize 1031 alongside of a syndicator, operator, sponsor in a commercial real estate transaction. We're going to talk about the instructions about 1031, how to utilize it, how do you syndicate and also utilize 1031 in the same deal. What happens if you need to bring debt, right? If you're coming alongside, you have cash, but you also have debt. What does that look like? 1031ing into a multifamily transaction. What is this mysterious thing, this 1031 exchange? The easy rules, we want to strip this down to its bare essence and provide you some easy rules for you to follow. And then talk about, like, why are 1031s so historically stressful, and how we might be able to remove some of the stress factors if you're thinking about it from this equation. So a little bit about myself. For those of you that don't know me, I'm the managing shareholder of Kelley Clark, licensed in multiple states. Our firm is active throughout the country, representing passive investors, sponsors, operators, syndicators, and all phases of the commercial real estate acquisitions. We've represented deals in excess of over $20 billion. On average, we're around $4 billion in structured transactions each and every year. And then we also have litigated in this area against banks, hard money lenders, company fights, and arbitration, state and federal courts. So right off the bat, right, we know the tax code is a monstrosity. One of these favorite quotes is from Steve Forbes, who says the tax code is a monstrosity and there's only one thing to do it. Scrape it, or scrap it, kill it, drive a stake through its heart, bury it, and hope it never rises again to terrorize the American people. Well, there's a lot of sentiment that is common in a lot of passive investors. A lot of syndicators, operators, and syndicators think this same thing about the tax code. Well, there are certain provisions of the tax code that are actually helpful, very beneficial. And one of the key ones that we're talking about for you today is this concept of what a 1031 exchange is. Some of you may have never even had to go through or gone through a 1031 exchange. Maybe some of you have never, as a syndicator, operator, or sponsor, have never thought to yourself that this is really applicable. Not so. We're going to show you how both sides, both investor as well as the people that are putting the deal together, why it's important. So when we talk about 1031, we're talking about an actual section of the Internal Revenue Code. This is the tax code that enables a taxpayer to sell their investment property. That's the property that they're selling, with little or no tax liability on any resulting gain, preserving the sale proceeds for the purchase of another property. So instead of being diluted by paying taxes and having less equity necessary to buy another property, you're able to utilize this section, which is a wealth building loophole, to help you acquire future properties. And it continues an investment without any adverse tax consequences. All right, so some strategy terms here, right? So we're talking about tax deferred, not tax free. There is no magic wand that automatically says you will never have to pay taxes. So if you utilize these key strategies, and obviously you should check with your legal advisor and with your own tax preparer, you're deferring the tax on the sale of your relinquished property. That's the property that you're selling. And then you're using the money to buy a replacement property. That's the property that you're going to buy, either 100% or a fractional portion of that. This 1031 exchange strategy, you can do it as many times throughout your life. And if you are very disciplined, so if you're so disciplined that you continue to utilize this, continue to sell, acquire, sell, acquire, all through the use of 1031 intermediaries and exchanges. When you pass away, your heirs will actually inherit a step up in basis at death, date of death. And that is where the capital gains go away. So depreciation recapture goes away. So that is the one area in which theoretically taxes go away. There's no limit to how many times you can do a 1031. Okay, let's talk about some easy rules. So we tried to make these rules as simplistic as possible for you to get this so that everybody can kind of understand this. So one, all cash proceeds from the sale of the relinquished property. Remember, when we use the term relinquished property, we're really talking about that property that you've sold, the property that has resulted in the money that you're trying to save and not pay taxes on, must be reinvested in the replacement property. That's the property you're going to acquire. Or guess what? If you don't do this, you're going to pay the tax. Number two, the purchase price for the replacement property must be at least as much as the sales price of the relinquished property. Or guess what? You're going to pay the tax. Number three, the purchaser of the replacement property must be the same as the seller of the relinquished property, or can be what the IRS calls a disregarded entity. So let's talk about this one real quick. I have lots of conversations with husbands, wives, individuals who are currently on the title owner of a piece of rental property. Airbnb, doesn't really matter. It's one of these things. They're renting it currently out. It's in their own name. They want to put it into an LLC or something for asset protection or for other benefits on the replacement property. And the question is, can they do that? And the IRS says, yes, you can, because a limited liability company for taxation purposes can be treated as a disregarded entity. That just simply means that the IRS is going to look through that entity to actually who is the true taxpayer. And as long as the true taxpayer of that is the same taxpayer that sold the property, regardless if you're changing from your individual name to now it's going to be held in the name of a limited liability company, that is fine. So that's good news for you folks out there that are thinking to yourself, I want to own this in an entity. All right. For safe harbor protection, exchange funds should be held by what the IRS calls a qualified intermediary. Well, what the heck is a qualified intermediary? These are entities that are essentially acting as a buffer between you and taking possession of the funds that have resulted from the sale of your relinquished property. So at title, let's say you have an Airbnb, you're going to sell that because you want to roll this into, or theoretically talk about potentially investing into an apartment building or something larger than what you presently have. And you want to make sure that you've hired a qualified intermediary before you close. They will take possession of that money. They will essentially have it in their escrow account, and then they will redeploy your money into the next deal, that replacement property. The funds from your sale are held by this QI. You might have heard the term QI, that just refers to this qualified intermediary, and then they're transferred into the replacement property transaction. Number five, your purchase of the replacement property has to be like kind. That just means that it is intended to be held for rental, investment, or use in a business. You're not going to live there personally. This has got to be a commercial use. And the idea that that if you own Airbnb, you have to go to Airbnb, raw land to raw land, not so. you can you can mix and match any one of these things on this list here. So you could go from single family to multifamily, multifamily to commercial office to industrial, industrial back to multifamily, oil and gas interest, mineral interest. Lots of different ways in which this like kind description, but the point is that it has to be like kind. You can't use the money that you got and then go buy a car with it. Cars are not like kind, or buy a piece of fancy art. That's not like kind. But the IRS says we're going to give you lots of leeway, lots of leash to be able to negotiate, buy and sell inside of this, but it has to fall into this like kind space. All right, what's the timeline? I've got these rules, got the 5 rules, these rules, but what's the timeline theoretically that I have to implement all these rules? Well, it's 180 days. And day 1, this is the day after escrow closes. So after the money is released from the title company on the property that you're selling, and it goes over to your qualified intermediary. Remember, you're going to hire that QI before you close on your sale. The QI takes possession of that money. That is day 1. You have 45 days to identify replacement properties. And it doesn't have to just be 1, 2, it's usually around 3 properties you're going to identify potential replacement properties. And then by day 180, you need to have closed on 1 or more of the relinquished properties. The 1031 timeframe begins on that day, and there's no extensions. So this is a very rigid rule. The only time I've ever seen the IRS in my lifetime bend this rule slightly was during COVID. And they only did it for a very short period of time, where they basically told that period. So you cannot expect the IRS to do that again. You really have to maintain this rigid deadline. And if you miss out, or you don't comply with the guidelines on this 180-day period, then guess what? You pay the tax associated with it. So you need to make sure that you're getting that your team is on it. All right. Why are 1031s historically so stressful? Well, I know from personal experience over the last 20 plus years of practicing law in multiple states and representing people that go through 1031s, that it's hard sometimes to find properties that pencil out, particularly if you live in markets like I lived in California for a long time. And the market that I lived in might not have deals that will cash flow, right? Maybe there's a high barrier to entry. And so you're trying to figure out, how can I invest in other states, maybe where the purchase price isn't so high, but yet there's lots of rent growth or people moving to that state. So if you're somebody that lives potentially in California, but you're looking at investing in maybe like Florida on the other side of the country, there's a problem, right? So unless you know somebody to help you navigate that process, that can be stressful. Working with banks to try to qualify for loans is not always easy if you're going to put leverage on the property. There's sometimes a catch-22 for real estate investors, right? Buying these value add properties means lots of work, meaning you're actually going to have to implement capital expenditures at the property and time and money. And do you have that time and money to be able to do that? Versus buying a turnkey property, maybe there's not enough equity left in the deal, if any, and the market in which you're potentially buying in, maybe it's not appreciating at a level that is satisfactory to you to implement your business plan. So all of these things are stressful on people, individuals or entities that are looking to historically utilize 1031 exchanges. Well, there is this concept that came into existence, and that was the idea that if I go into a property with more than just one person, that will help somewhat resolve some of those stresses that we just talked about. And that's where this concept of tenants in common, or maybe you've heard the concept, this word TIC, not the little animals that dig into your skin or under your thing, depending if you live in the Pacific Northwest or other mountainous climates. These are actual concepts that will help you. This ownership in which two or more people or entities own separate shares, or what we call undivided interest in real property, are the same property. So each person or entity that participates owns an individual undivided ownership interest. And this is beneficial for someone who no longer wants to actively manage the real estate. Maybe they're looking for income and tax deferral benefits. It also helps the average person or somebody that's looking to have high credit rated tenants, as well as geographic diversification. And usually the experience or they want somebody to have experience as far as assisting them in these markets. So this is considered like kind. So participating, remember that's one of the requirements of being able to 1031. Participating in a TIC or a tenant in common structure is a like kind process. All right. Well, why are these the benefits associated with this participating as a tenant in common? Well, it increases your buying power, right? So you now have the ability to take that one asset that potentially you or your wife or somebody else just owned individually, and now you're able to get into a much larger scalable asset like multifamily or self-storage or mobile home parks or commercial. All of those things helps you to scale into a larger thing. You have now the ability to tap into this passive investment potential. Like you might have a professional property manager or a professional asset manager, or maybe the general partners of the syndication are going to act as the asset manager, the day-to-day asset manager on this TIC structure. It helps you diversify into key markets within the United States, right? You don't need to be an expert or have an expert, right? In our analogy of, I live in California, but I want to invest potentially in Florida. Well, now I don't have to have, theoretically, I don't have to be the expert in Florida because I have somebody potentially in Florida managing that asset for me. And well, I still am able to take advantage and live in California. You don't need to qualify for financing. This sometimes is very helpful, especially if you're going for agency financing like Freddie or Fannie, right? It dramatically decreases all of these things. These factors are helping you to dramatically decrease the risk and stresses of the historical challenges for people that have utilized 1031. So if you are a passive investor and you're thinking about, oh my gosh, well, this is a possibility potentially for me as a passive investor. I never knew that I could come along and participate in a tenant and common structure with my money and increase potentially my buying power, appreciation, cash flow, all of those things, and decrease some of the risks as well as the stresses that are associated with this. Well, yes, you can. And that is some of the very many benefits associated with being able to implement this strategy. All right, let's talk about what the typical deal structure looks like in a normal syndication, and then we'll talk about how it potentially changes if you're going to participate alongside in a TIC style structure with a syndication. So normal syndication, right? We've got the normal limited partners, general partners, or Class A members, Class B members, right? They're going to own this building. The NewCo LLC, this NewCo LLC is going to own a building. The asset managers, best gals, best guys. These are two other entities. These are they're the people that are putting the deal together. Typically, they're going to be the sponsors. In this hypothetical, we've got a 70-30 split. Got a 70% owned by passive investors and a 30% owned by the sponsors. Very standard structure. Well, let's look at what it looks like when it changes. So now we've still got this potential 70-30 split, but we've got the fact that we've got two other entities that are participating. So now we've got basically 3 potential co-owners of the same piece of real property. So now our apartment building, new co, same asset managers are there, but now we've got a tenant in common interest by Tinker, who has 3%, and we've got Taylor, who has 5%. So between those 2 entities, they have 8% undivided interest in the real property. And so now the balance of 92%, 62% of passive investors, and then we still have 30% that's held for the by the sponsors. This is a very common structure in the TIC world. So now we've got basically what we would say is 3 co-owners of the same piece of real property, all participating at the same time, all participating in the same structure, all represented on the deed, all represented on the loan documents, all participating. And now they are able to deploy that capital from the qualified intermediary into this same deal. And so you've got a 3-party TIC structure. Okay, so how do I calculate the percentage for projects, right? One of the big headaches potentially, if you're thinking about this from the sponsor side or the passive investor side, and you're thinking about, okay, what I mean, I have some money and I'm trying to think about how would this actually work itself out, right? Well, here is a formula potentially to be able to utilize that, and that is you're going to take essentially the equity that is needed to be brought to the table, and you divide the cash that somebody is coming into that, and that is one way to essentially work out what the undivided interests of the real property are. So here you've got basically a 70-30 split. Somebody is coming and dividing essentially the cash, and you times that by 0.7, and you will work out to essentially in this formula right here 1.4%. So if somebody were to invest essentially $500,000 in this particular formula, that works out that way. So it doesn't matter what the numbers are that you're in this particular formula. This is just one example, right? One non-exclusive way in which to calculate that. The key terms are, what's the amount of cash that somebody is bringing to the table? What's the raise, right? What's the amount necessary to get the loan to actually buy the property, to get the keys to operate the asset? Okay, what portion, if we divide the amount of cash into that equity, and then if they're going to be further diluted as like a limited partner, meaning you're going to times by the amount of the split between investors and sponsors. That's how you calculate what those undivided interests are. But that is one option and one ability for you to figure that out. Okay. There is we're saying, okay, now we have an idea of, okay, we know theoretically how some people calculate undivided interest for the real property. We know that if I bring this amount of money, then theoretically this is what I could expect to receive at closing. But how do we participate? Since you've told us that Tinker, Taylor, and Newco LLC, they're theoretically all 3 separate entities. They're not in the same entity with one another. Well, that is correct. They're not in the same entity with one another. They participate with one another through what we call a TIC agreement or a co-ownership agreement. Remember, there are a couple principles that it's important for you to remember. You are co-owners. All of these people in our hypothetical, Tinker, Taylor, and Newco, they are all separate and distinct co-owners. They're not partners with one another. Each co-owner holds title to the property as a tenant in common. Ownership between the TIC parties will be governed by this TIC agreement. The TIC agreement generally mirrors the operating agreement for the syndicated entity, but not always. it could have different terms depending on what the equity members have, right? So NewCo LLC, that's the syndicated 70-30 split between the investors and the sponsors. Tinker Tailor, they also have their own entities. They're going to have their own operating agreements, but there's going to be an operating agreement that exists between essentially the three of those entities that governs how what rights people have, when do they vote on certain things, what's the annual theoretically budget for operating the company, who's going to be the property manager if not, what are the fees going to be charged, if any, between the asset manager and those various things. That's generally speaking what you're going to see, and that's going to be encapsulated in that TIC agreement. What's going to happen on a sale, who gets to decide when the property gets sold. All of those things will actually eventually have to be passed through the lender as well, because the lender has to know the structure, has to bless the structure, has to review those documents, and ultimately has to approve those documents. Otherwise, the structure never happens. So ultimately, you got to remember all of these things are being reviewed by the lender and their counsel as well. All right. The key components. So at exit, what happens if I want to basically have the ability to actually, I want to create a tenant in common thing, but I'm trying to do it after the fact, meaning I've got a syndicated entity, and now I've got potential investors who want to go through an exchange, and now I have some investors who don't, and they want their cash and they want to pay their taxes. And what do I do with that? How do I figure that out? Well, we reverse a 1031. And in this hypothetical, we would essentially identify which investors are going to want to remain with the entity and go through the forward exchange towards another deal, and what individuals will want to essentially be dropped into another entity to receive their cash and pay their taxes. And so the key components of this is also called what a drop and swap potentially is. There's a deed from the entity. So in our hypothetical, like NewCo LLC would deed out a percentage of interest. So imagine if Tinker and Tailor were actually investors in NewCo. So NewCo now deeds out Tinker's interest to Tinker, deeds out Tailor's interest to Tailor, and we've got now a three-party TIC, and the members of the entity proceed to closing, and those who want to go through the exchange do so. So the syndication would go through, and everybody would take their cash and pay their taxes, and Tinker and Tailor theoretically go through the exchange, or vice versa. Your operating agreements in your entity should allow you to do this, or you need to amend your governing documents to essentially provide for these strategies. All right. The hardest thing in the world is to understand the income tax, right? So Albert Einstein said that way back when. It's very true now. But I hope that what you can see from this short presentation at a very high level is that there are provisions of the tax code, namely Section 1031, that allow you the ability, regardless of whether you're a sponsor, regardless of whether you're an operator or syndicator, or even a passive investor, to think about being able to redeploy your capital in a different way, leveraging and taking advantages of opportunities out there. And 1031 is one of those things. So for those of you that have seen me before, you know that I like to finish on a high note of positivity. I'm a big believer in the power of positive thinking, especially in uncertain times like there are now, with capital markets appearing to be in upheaval. Sometimes it's trying to figure what's the pulse of the debt market going to be. What about interest rates and all these things? Well, some things we can control and some things we can't. So the reality is it's important for you to have a positive mindset, especially in 2023, as you're looking for opportunities to do deals. And I want to leave you with one of my favorite poems. It's a poem by Mother Teresa called Anyways. And it basically says people are often unreasonable, irrational, and self-centered. Forgive them anyway. If you are honest and sincere, people may deceive you, but be honest and sincere anyway. If you're kind, people may accuse you of selfish, ulterior motives. Be kind anyway. If you're successful, you'll win some unfaithful friends and some genuine enemies, but succeed anyway. What you spend years creating, others could try to destroy overnight, but create anyway. If you find serenity and happiness, some may be jealous, but be happy anyway. The good you do today will often be forgotten, but do good anyway. Give the best you have, and it will never be enough. Give your best anyway, because in the final analysis, it is between you and God. It was never between you and them anyway. I hope this has been helpful for you. If you'd like to learn more about us or me, or some of the free content that we provide to you, here's some contact information. You can find us on YouTube, Facebook, Instagram, and obviously at our locations and our telephone number. And you can always hit me up with an email. Send me an email. We'd be happy to give you a free consultation and talk to you about your particular deal and how we might be of service.